Good day. My name is Jack Corgel. In addition to being the Robert C. Baker Professor of Real Estate at Cornell University, I'm a Senior Advisor to PKF Hospitality Research. And with me today is Scott Smith, Vice President of PKF Consulting and an expert on hotel valuation. This is a special edition of Lodging Insights to introduce our Hospitality Investment Survey for 2014 that was recently released. Scott, the title of this survey is At Peak Performance, and I guess that suggests that we're at a peak in the market from the standpoint of investments, both equity and debt. What would you say on the equity side was perhaps the highlight of this particular survey?
Our respondents on the equity side, similar to last year, indicated that the loan-to-value ratios are up briefly, maybe 50 basis points what they were last year, from about a 65% loan-to-value up to about a 67%, 68% loan-to-value. So they are increasing slightly over the previous year. So interest rates remain the same. Debt equity requirements, dividends remain the same. But we're looking closely at the markets to see if that loan-to-value ratio is going to be creeping up to historical levels.
Okay, I want to come back to loan-to-value ratio in a minute. But how about cap rates? Are they moving in any measurable direction, up or down?
No, our respondents basically indicated, similar to last year, cap rates remain steady both for limited service and for full-service hotels.
The peak that we're now at, assuming that the recovery period is either over or very near the end, is similar to the peak we saw in 2005, 6, and 7. And we're approaching, according to the survey history, the highest loan-to-value ratios that we've seen since that period. I think that period is around 69 or 70%. We're now at 67%. Do you think this gives any indication that leverage could be creeping into the picture and a potential problem?
I don't think it's a potential problem at this point. However, you still have to factor in other types of capital stack, mezzanine financing and what the cost might be for that as well. From the lenders that we've spoken to and responded to our survey, they've indicated that they're still, trying to be as conservative as they can in all segments of the hospitality industry. So at this point in time, I really don't think there's too much of a threat of being over-leveraged in the hospitality industry.
Good. How about limited service versus full service and some of the other market segments? Is there anything distinguishing that you've seen in your evaluation work out in the field that you think is particularly relevant to today's market?
Sure. What we're seeing in the market studies that we do, as well as the appraisals that we do, there's a lot more debt available for limited service properties. Obviously, the replacement costs are approaching a point where values are equaling replacement costs or exceeding them in some markets. So it determines upon market specific as usual whether it makes sense. But it appears that most segments values are increasing, most hotel property types are increasing, and that the limited service or focused service product is the one that's getting most financing, whereas full service properties continue to be the most difficult unless they're a public-private partnership where there's certain tax advantages to financing and whatnot. So.
And you're seeing a lot of transaction activity as well, correct?
I'm seeing a lot of transaction activity, but there again, our respondents have said that the quality of the product available for sale in the market really isn't where they would like to see. There's not a lot of good quality product available out there, and as a result, a lot of the property values are being bid upwards as there's a scarcity of good quality product out there.
And one final question: do you think values are equal to, less than, or greater than cost at this point?
In most markets, they're probably equal to slightly below cost at this point.
But approaching.
Quickly approaching. What we have to do is keep an eye on what our labor costs, construction costs are going to be. as well as land cost, not only for hotels but alternative land cost.
Okay.
So I think those land costs and construction costs and labor costs are still going to continue to increase in the near future.
Well, we hope we found this video interesting and informative. We will see you next time on another edition of Lodging Insights. Thank you, Scott.
Thank you. For further information on the Hospitality Investment Survey, please visit our website. If you need additional information regarding our appraisal services, market studies, litigation support, please contact me at scott.smith@pkfc.com. Thank you.